Hello YouTube, what's up traders, it's PZFS right here. Welcome back to my channel. In case you're new, please consider subscribing and turn on post notification, because in this YouTube channel we share strong technical tools that are going to enhance your profitability. It's going to redesign and also recalibrate how you trade this market. Like how that sound, give us a thumb. If you're a trader, I will urge you to spend 5 minutes of your time to watch this video, because in this video I'll walk you guys through everything you need to know about inducement and liquidity. With that, you will stop blowing your account in the forex market, the stock market, or the crypto market. So guys, stay with me. Let me walk you guys through my chart. So this is my chart, and this is NASDAQ 100, of course the 30-minute time frame. So now the reason why I like staying on the 30-minute time frame is because it's my execution time frame. It is a time frame where I take my position. So now let me take you guys to 1 hour time frame where I do the analysis. So first thing first, you come on the 1 hour time frame. Now guys, talking about time frame differs when it comes to the type of trader you are. If you are a swing trader, you have to stay in higher time frame. If you're a day trader, lower time frame. If you're a scalper, you can just play around with 15 minutes, 5 minutes, or even 1 minute. Since we're a day trader, let's stay on 1 hour time frame. So on the 1 hour time frame right now, this is NASDAQ 100 and 1 hour time frame. So now we establish our break of market structure. So we have our break of market structure 1, and we have break of market structure 2. So after we had something like this, the next thing I do, I just have to mark out my order block. So my order block was somewhere around here. So now the reason why I'm not going in details on how to mark out my order block is because I had videos that talked about my order blocks, which is the liquidity candle that you usually have to mark before price get there. Then you start buying or you start selling alongside it. So I already made a video about that. Check here or here, you see a link, so you go watch that video. So now we marked out our order block around this region. Then the next thing we do, we have to go back to the 30-minute time frame. Now on the 30-minute time frame, there are two things you need to look out for. You need to look out for inducement and also liquidity. So now what is inducement, guys? Inducement is a point where price form a kind of pattern that will force some traders to go into the market, and liquidity is where that trader will put a stop loss. This is what I mean by that. Now you have this setup right now on the 30-minute time frame. You want to buy the market. You want to buy the market from here, and you want to exit from this side. So how will you know price is going to get to that side? So now, where is the point of inducement and where is the point of liquidity? Now, inducement usually force trader to enter the market, premature entry. That's what I call it. So now, people that trade the smart money concept, obviously they will mark here as a valid break of market structure. Then the next thing, they will look out for their order block around this region. Okay, so now once they look out for the order block around this region, then let me zoom in for those using phones. So then they might establish here to be their so-called liquidity, and they'll want to buy the market from here. Sorry. So now they want to buy the market from here. This is not like they are wrong, but then again, what they are missing right now, they are missing on inducement. Markets always form inducement. So when you understand where inducement is in the market, you have to stay away from there. If not, you will blow your account before you see that move that might make you good money. So this is what I mean by that. Now they establish this region to start buying the market around this region. Okay, it's not like they are not, but they are missing out on inducement. So this is the point of inducement. This side that they are buying is a point of inducement, this region. So now after they place their buy around here, where do you think they will keep their stop loss? Obviously they have to keep their stop loss either below their point of interest or below any wick around there, and we all know that wicks in the market represent liquidity. Now this is what I mean by that. Once they buy the market around here, they will keep their stop loss beneath here. Now this is where they will drop their stop losses, obviously, because this is NASDAQ 100. You don't want to play around with big stop losses. Okay, so they keep their stop losses around here and they start buying the market. So here will be their point of stop loss. So SL around here. Okay, so now with this, we've able to understand that this is a point of inducement and this is a point of liquidity. So now these two places have to be validated before price have to get to your point of interest. Then you start buying, then you know you saved. Now, not all the time you see inducement and liquidity. Whenever you see inducement, there must be liquidity. Whenever you see liquidity, it might not be that there is inducement there. Inducements are points that force traders to buy. You might see double bottom, double top. You might see break of structure. Then you might see your favorite pattern along that region. But then again, when you look down or you look up, you find out that there's a valid place that price is more likely, I said more likely, to get to before it starts reverse. So now this is what I mean by that. After you've established this region be your point of inducement and these are your point of liquidity, then you'll be more confident, not just 100% confident, it might be like 75% to 80% confident that price have to get to this region for us to start buying alongside the market. So this was where we bought the market, I and my team, and we dropped our stop loss below here. We were risking 50 pips. Guys, this is 50 pips, not 500 pips. It's 50 pips. A lot of people have misconception when it comes to pips in index, even stock market, even Forex as well. They have this misconception. They don't know how to calculate pips. So this is 58 pips, not 5,000 pips. Okay, so we're risking 58 pips and our take profit always is 1:5, guys. 1:5, and we use pending order. Like I said, if you want to trade with us, always use pending order. Okay, so we have pending order around here and we add 1:5 to the upside. Now guys, I'll be leaving a screenshot around this video so you see that we did cut this trade on 1:5. Guys, if you want to trade with us, all you need to do, you have to check in the description down below, join our Telegram community, stay there guys. You're going to be seeing trade setup. We might not be sending 100 trades, 50 trade or 20 trade, but trust me, once we drop one or two, those trades are banger. And if you want something private, you can also come up to the VIP session where you'll be more prioritized than the public session. This trade right now, we send this trade to the premium community, which everybody profit from this trade, and it was a very, very nice trade that will clear out all your losses. Imagine, this is 1:5. You need to have 5 losses, and if you're trading with us, what is likely to happen is you having 2 losses or 3 losses. So once you have that one win, 1:5, it will clear everything and put you in massive profit. And this is what we did. We had our trade around this region. Our stop loss was below here and our take profit was above this region. So now this is how we use liquidity and inducements to cut this beautiful trade to the upside, catch you 1:5. Guys, this is going to be the final lap on this video. Please, I want you to subscribe. Just take your time. Subscribe. It's not going to take you anything. Just click that subscribe button. Let's grow together. Until next time, bye for now.